Jose Minaya of BNY Investments and Wealth writing this: volatility is here to stay. Stay invested and look for the right diversification. Jose joins us now for more. Jose, good morning.
Hey, good morning.
Just want to pick up on that first line. Volatility is here to stay. Why is that?
Look, I think volatility, clearly we're at an all-time high or peak in terms of the noise in the markets. If you just think about back to the beginning of the year, our team kind of added around 26, 27 different policy changes or news cycles that really kind of impacted or jolted the markets. Yet the markets have kind of powered through that, right? I think I was on one of your shows earlier in the year saying around, hey, you should not be risk off. And this was like right after Liberation Day because of like what we're seeing in the fundamentals and trying to look past this noise. Seeing a White House and administration, there's a little bit around the carrot and the stick, right? We saw a lot of the stick at the beginning of the year. Now you're seeing more of the carrot. And again, the markets are responding to that. So it's less about today when we talk to our clients around, hey, what should you be invested in or not? Or what, it's more about what are the solutions you're looking for. You're seeing more and more of that in the industry, whether it's technology with kind of SMA capabilities, what you're doing with model portfolios, which we do in BNY Advisors. Across the board, it is about staying invested through these times, but kind of understanding what outcomes you're looking to get.
Well, let's run with that. Stay invested, long-term time horizon. Got it. What are these strategic anchors you're offering people to get them comfortable with doing just that?
Well, I think, again, it depends on their needs and outcomes. In some cases, it might be, hey, they're looking for income, right? Like, we create a lot of like what we call like, you know, bond portfolio in a box or personal bond portfolios with our Insight investment platform, where it's like we're getting very customized in how we deal with our clients. It might depend on when are you looking to retire? Is there a wedding? Is there educational needs and these things? So you might need principal protection. I've got a new niece on the way. In that case, I'd be like, hey, you should just go long equities. So again, we could spend a lot of time thinking about the noise, the volatilities out there. If you look at, it hasn't paid off to just say, I'm going to stay off the markets. And there's still a lot of cash out there. But again, that idea of I'm going to stay invested, but am I really focused on my solutions and my outcomes versus call it a 60-40 type of portfolio?
Congratulations on your incoming niece and going all equities in response. I am curious, though.
For her. Yeah.
For her, for the niece, not necessarily the parents. But I am curious about how much going forward the ballast for income comes from the same place. You said not necessarily a 60-40 portfolio. Let's say someone is conservative and looking for income. Does it still come from U.S. Treasuries? Does it still come from credit? Or do you have to look elsewhere for that type of ballast?
No, I think the markets are becoming a lot more efficient and they are looking elsewhere across the board. Again, we've seen the advent of private credit. It kind of plays a big part of this. You saw with the Secure Income Act where now annuities and guaranteed income contracts are being allowed to be used in 401k portfolios. I think these are all important legislations that are all kind of recognizing the incredible crisis we have from a retirement perspective, not just globally, but definitely in this country. So you need to kind of look more broadly.
There's a little bit of skepticism in younger generations, it seems. There's this concern that maybe the same kind of gains that the older generation saw in their portfolios are not going to subsist in their generation. Do you think that it will? Do you think that the returns will be the same in the next 10 years that it has been for the past 30 years for a generation that has gotten wealthy off stock market returns?
I don't. And what I mean by that is, if you look back over the last 20 years, you would have been, for all this discussion around different investments, hedge funds, private equity, at the end of the day, you would have been just fine doing a very low fee, kind of like passive equity funding. You would have been just fine. I don't think that's the case in the next 10 to 20 years. It's just a lot more volatility. There's a lot more volatility out there. I think returns are going to be more measured, yet it's, again, finding your spots. Again, it's not about anymore, can I find the strategy that just I can sit back and it's just going to grow 15, 20%. It's being able to do the work around how you diversify your portfolio.